We are here. We are back with the BitcoinTreasuries.net takeover from Psalion, joined again by Tim Enneking, the managing partner of Psalion. I am Alec Beckman, the vice president of growth at Psalion. And today we have an amazing guest, a truly unique structure in the Bitcoin space that I haven't seen. We're joined by Brian Phillips, the managing partner of the Pearl Bitcoin Fund. Brian, thanks for joining us. Great to see you. I when we spoke a couple weeks ago, I immediately said this would be the perfect thing for the podcast webinar series that Tim and I are doing on BitcoinTreasuries.net. So, Brian, would love for you to introduce yourself and give the audience a taste of what your background is and how you entered the space.
Yeah, sure. Thanks for having me on the show. It's great to be here. Hello, everybody. I'm Brian Phillips. I'm the managing partner of the Pearl Bitcoin Fund. We are the country's first tax-free Bitcoin fund. Um, and we have been able to use some of the tax code from the Tax Cut and Jobs Act and now built into the big, beautiful bill for U.S. investors to be able to invest in Bitcoin. And if they're patient and hold it for 10 years or longer in this particular structure we'll talk about today, they will be able to do sales of their Bitcoin from anywhere from 10 to 30 years in total, completely tax-free of capital gains tax. And my background is a serial tech entrepreneur doing software startups myself, and then being a venture capitalist for a while, and being fortunately an early Bitcoin investor since 2013 in the fan. So we'll get into those details soon.
Amazing. Amazing. And Brian, before we hop into some of the topics, I think just learning about how in 2013 you entered the space, heard about Bitcoin, and then moving through, just would love to learn about how you got involved with opportunity zones and how you started to learn about that structure and
Sure.
combine. Yeah.
So yeah, back in 2013, I was attending a financial seminar, and I give credit to Henry Blagett, who ran Business Insider, and he was speaking at the Yale Club here in New York City, and he was talking about something I don't even remember. But at the very end of the workshop, somebody stood up in the audience and said, "What do you think of Bitcoin?" It's 2013, about $200, and he said, "You're either gonna make a ton of money or you're gonna lose everything." He's like, "So only invest what you're willing to lose and then just forget about it." So being a tech entrepreneur and early in a high risk tolerance, I'm like, this sounds really interesting. I'll buy a little bit. And I actually forgot about it. And in 2017, it was all over the news that it had gone up to like $2,000. And I actually remember exactly where I was sitting looking online about that and said to my wife out loud, "You know what? I think we bought some of that stuff." And I had to search on the term Bitcoin in my email, found Coinbase, and found and had to get all logged back in, figure out how to log back into Coinbase. And there it was. And I'm like, oh my God, I'm a genius. It's just luck, and I, like
Gonna
everybody.
say the old aphorism is better lucky than good, and there's a wonderful example of it. Although I'm sure you're both, Brian. I'm sure you're both
Right,
lucky
right.
and good.
Well, I am like every other person I've ever met. An orange pill is, I wish I bought more.
Yeah, right,
Right?
right, exactly.
We all say that.
Before you shift to Alex's other question, there's something that it's just a bizarre factoid about one of some of my experience that dovetails insanely well into
Mm.
what we're about to talk about. I was the CTO of an almost 10-digit family office based, chief technical officer, chief investment officer, CIO. God, I've been in crypto too long. CIO of a almost 10-digit family office that did no digital assets, no crypto whatsoever. I was in that position for 9 years. I stopped just under 2 years ago and was able to triple the value of this family off, more than triple the value of the family office in those 9 years. And, again, not using any crypto. So I'm vaguely familiar with non-crypto stuff. One of the biggest things that we did was investing in opportunity zones. And in fact, we set up our own proprietary opportunity zone fund, which is something that sounds very complicated, but I've never been intimidated by things that look complicated from the outside. And it's actually quite simple. So when Alec mentioned that you would combine OZs and Bitcoin. I thought that is brilliant because, if nothing else, because of the capital gains treatment. And the laws on OZs have been updated actually since I left that family office. So I'm really curious to hear this because I know a lot about these two things separately, but I never even thought about putting them together. So this conversation will be particularly interesting. Combines lots of really good stuff. So tell us a little about the audience about OZs because not everybody knows what they are.
So I told Alec this story. He thought it was interesting. So let me wind back a little bit about opportunity, why I got into opportunity zones in the first place in the tax law, because we were the first opportunity zone venture capital fund just as soon as the law passed. But the reason I got into that is I had done a number of startups, 2 got acquired and 2 went public and a couple that never made it. And I started doing some work nonprofit, and what I wanted to do is really stay in the world of entrepreneurship. And so I worked for some nonprofits that really worked with entrepreneurs in the developing world. So somebody, called Endeavor Global and another one called TechnoServe. I ran worldwide entrepreneurship for these nonprofits in Africa and Latin America primarily. And Goldman Sachs put together something called the 10,000 Women Project. And what they did is they did some research. And the research was the number one way to improve an emerging economy in another country is through SME entrepreneurs, not the microfinance, but the small to medium. And when you help and resource those, they grow rapidly. And that has the greatest economic impact that you could have in any country that's a developing country. And the best of the best are women entrepreneurs, because women SME entrepreneurs hire more women, and women typically spend more of their growth capital that they have in investment into their children, into nutrition, into education, and that causes great economic improvement. So I joined Goldman Sachs. They gave these women, 10,000 women, a hard selection process, sort of like an executive MBA, entrepreneurship MBA, for the most prestigious university in every country, Tsinghua in China, ISB in India, et cetera. And they hired me to go out and help find the 10% top women in the world and pick those women out and find local resources to help them continue after the education.
A fabulous job to have. My God.
I have met the most inspiring women entrepreneurs in the most remote parts of the world you could ever see. It was a
Fabulous.
crazy good job. So the reason I tell that story is because then the Opportunity Zone law passed. And what did that law say? It says that you can invest in the USA in low income census tracts and if you buy and invest in Opportunity Zone property and hold it for 10 years or longer, it'll be tax free for the investors. Property is defined in the Opportunity Zone law as real estate buildings in these zones or businesses that have 50% or more of their employees working in the zones. So I don't do real estate, but I said, I have seen this work in Mozambique. I've seen this work in India. Now it's in our own country. Investors can put this capital in to this structure. So I created the first Pearl Fund, which is a venture capital fund finding seed stage companies and investing in them and moving them into typically 2 or 3 founders, moving them into an opportunity zone.
Okay, Brian, I want
And
to stop you there because you blitzed through that so quickly. You're projecting all of your knowledge onto the audience. So I want to really just spin it back, but more slowly.
okay,
When the OZ law came out, it's designed to take underdeveloped portions of the United States,
yes,
foster investment into those areas,
yes,
and encourage general increase in the
mm-hmm,
quality of life,
mm-hmm, yep,
increase
yep,
employment, improve housing, et cetera, et cetera. So there is a map. You can go very easily, do a search, and you find a map, look any place, almost any place in the United States. And in every urban area, you will find areas designated as opportunity zones.
correct,
And it's interesting because there are humans involved in this. There aren't really bright lines on this side of the line. Oh, it's horribly underdeveloped. On this side of the line, it's wonderful, right? There are transitions. The lines are drawn in weird places. There are some fabulous neighborhoods in the United States that are in opportunity zones. And it's not
yes,
because there's something untoward going on. It's just because you got to draw on the line someplace. You connect 2 points, and what's in between may suddenly be really nice because a good a good area goes into the opportunity zones. And the opportunity zones zone areas aren't bad. They're not all beat up, bombed out areas. They simply haven't had the benefit of all the development that certain adjacent areas have. So the idea is to put money into real estate investment to improve the physical plant. That's prong one. And prong two is a business. So if you have half of the people or more in this area, then that entire business will be subject to opportunity zone rules. And the kicker, the really interesting thing is that if you hold on to these properties, and the businesses can be fabulous, they can actually have clients outside the opportunity zone. They can sell globally. It's just they have to have the employees in the OZ.
Exactly.
And then if you run this for a long time, the idea is let's not let rich people get quick profits. You have to run the business, and those rules have changed over time. Now I guess they're 10 years. I didn't know that. But you do this for 10 years and think about it. All the capital gains, if you start a little startup and turn it into a 10, 100 million, a unicorn, all the capital gains are tax-free. It's absolutely nuts. It is it's a fabulous opportunity, not without risk, because you're investing in the opportunity zones. You're working in the opportunity zones. You have the capital in for 10 years, which is why you say, forget it. But the tax benefit is insane, totally insane.
I agree. And just for a little backup on there, the opportunity zones are census tracts because it's based on a poverty level. So a census tract is not a township or a city or a county, right? So there are some very strange census tracts, to your point. One. Two is the governor of every state was able to pick 25% of their eligible census tracts and designate them as zones, right? So there are still 75% of the census tracts that would qualify, and they're not opportunity zones. So you have to, Tim's point, you have to go to a map. You can go to Google and say census opportunity zones map and enter in any address, and it'll zoom in and you can show where it is. Three is all of those zones, it's a 10-year period, are now expiring at the end of 2026. In 2027, opportunity zones was made permanent by our Congress and our president. And so all of the zones will be reassigned. Some of those have developed and are no longer qualified. Some of them have not, and they'll be repicked, and there'll be new zones that are be picked. And they were actually forced to pick some that are in rural settings as well. So the governors are right now all deciding which new zones are going to be picked. So this is sort of our expertise is we can do real estate investing, but there are already thousands of opportunity zone funds that do that. We are one of the only funds in the country that says, no, we're going to do businesses. Why? Because we can have a much bigger return than real estate. If you got a unicorn, or even if you got a 10X, or, that's big. In real estate, maybe you double or triple in 10 years. If you got a winner, that's kind of a loser in venture, right? So it's really an ideal program to get going. So we learned.
Sorry to interrupt, but let's be fair. You talked about the reward, but there's a risk reward component, right? The real estate people are going to go into that. No, you won't have 50x returns, but you probably also will not lose all of your money. If you're going into a startup, you can lose everything, right? And get the 50x. So it's pick your poison, as it always is with investments, do your own research. But there's a different risk reward ratio here.
Exactly.
Yeah, but if you're going to do a startup, I mean, it's really not, do I do a startup or I do real estate? That's sort of an unfair and unrealistic comparison. The real comparison is, I want to invest in a startup. Am I going to invest in a startup located in the heart of Silicon Valley in the West, on the left coast, or Silicon Alley on the East Coast? And I'll be subject to all the usual tax things. And I might have QSBS, right? The qualified stock program that will defer some of this. Or do I invest in a startup, potentially the same startup, that I'm going to plop down into an OZ and I defer all capital gains if I hang on to this for 10 years? So you have to hold on to it for 10 versus getting out of a startup potentially shorter. Maybe it lasts 10 years. QSBS is 5 years, right? And so this is part of an overall tax planning view where you say, okay, look, if I'm doing the startup anyway and I believe in it, here I'm going to get nailed with taxes. Here I have none. That's where the question comes up. That's brilliant. I love that.
So what we did is Pro Fund 1 and 2 are venture capital funds. My background is software startups. So we've been finding high performing, high potential startups and moving them into opportunity zones. Here in New York City, they're over in the Brooklyn Navy Yard. What the greatest, newest WeWorks building is right there. So you move them in a co-working space and they're good to go, right? But we train them, these founders and CEOs, about how to comply with this law. And we report how many people have you hired, how many have left, which zones are they working in. They don't have to work in the same zone. You can have your team remotely spread out between multiple zones all across the country. But one of the problems is really hard to grow a lot of assets under management in the fund because we're always doing seed stage, right? Number one. And number two is, there's no liquidity until the company gets exited, or if you're in real estate, which we're not, until you sell that building, you don't really have liquidity. Bitcoin has liquidity 24/7, 365. And so since I invested since 2013 and spent a lot of time figuring out tax planning through my own self-directed Roths, these sorts of things with the Bitcoin, I'm like, with my compliance officer, my co-founder is this guy that reads tax code for recreation, one of those sorts of guys, Paul St. Pierre.
Condolences. My
He is
condolences.
terrific, So I'm like, can we do it this way, Paul? No. Can we do it this way, Paul? So finally, after a year of digging into tax code, he's probably the world's expert in opportunity zone business tax code, which is a very, very, very narrow niche. And he's like, okay, here's how we can do it. So I don't want to reveal all our secrets and things like that, but I'll tell you that basically what we've done is we've built our third fund is a Bitcoin fund, and it only is a fund that buys and holds Bitcoin for our investors in an opportunity zone structure. So we've built an opportunity zone fund. They must invest capital gains into an opportunity zone fund. Within 48 hours, that fund passes that capital down to an opportunity zone Bitcoin company based here where I'm sitting in Harlem, right, in an opportunity zone. That company is an asset management company. It's not an investment management company. What it does in 48 hours is buys Bitcoin on the OTC and puts it in custody at an institutional custody firm. We do not have to custody it in the opportunity zone. What we have to do is create jobs and have people who are working in the zone at our asset management company. So if our investors invest into this structure, or you can have your own opportunity zone fund. It could be a real estate opportunity fund and you want to diversify that. You could be a family office and have your own opportunity zone fund. It could be a treasury company that has Bitcoin and wants their own opportunity zone fund. All the work is really done down at the opportunity zone business level, our asset management company, which buys and holds Bitcoin and provides the jobs and the people who are working as an asset management company. Think of it almost like a Bitcoin bank, right? So you can bank that money into Bitcoin, but because Bitcoin is liquid, we allow people to pull it out every 30 days, any percent they want. So you're not locked in for 10 years unless you want the tax benefit, right? So you over allocate, or you make so much money in Bitcoin goes so far, then you're like, I'm going to take some off the table. I'm still willing to pay tax on it now and let the rest continue to grow tax free. You can do that. And you can't do that in opportunity zones with private equity, venture, or real estate. But we're taking the advantage and the strength of people who already believe in Bitcoin and are willing to do it on a long-term hold.
I really like this because then the choice is, I like comparing, A/B testing. I can put it in this Bitcoin ETF over here, right? And I will get the appreciation but there's no way you're going to get any tax advantage other than long-term capital gains if you hold on to it for a year.
Correct.
If you just bought it. Or B, door number B is your idea, your fund. You buy the same number of Bitcoin. If you want to sell it, you sell it. Yeah, worse off than you were before. You hold it for a year to get the capital gains. But if, based on how your life evolved, you hold on to it for 10 years, zero capital gains tax.
Exactly. And at the 10-year mark, it's all tax-free. You can begin to take off, say, $1 million a year tax-free, but let's say you put in you put in $1 million, it's worth $10 million in 10 years. You take $1 million out per year, to say the first year, the other $9 million is still growing tax-free. You can continue to do that all the way until 30 years. And at 30 years, you have to pull it all back out.
Where's the 30-year time limit from? Because that's the first I've heard of that. Where did that come from?
That is in the big, beautiful bill. So whenever you first invest, it starts a 10-year, 30-year clock. So if you did $1 million on February 1st, and then you did $1 million in September, you have two 10-year clocks, each with 10 to 30-year windows in them. And the thing is if you pass away, which some of us are a bit older and 30 years is a little long way. If you put it in a trust structure that bought into this, your trust inherits your clock. Let's say at 7 years you pass and they completely get everything tax free. So for generational wealth planning, for family offices, these sorts of things, it's really ideal. For estate planning, it's very unique in the US tax code.
It's really nice. Now, let me tell you, one of the things that we're really that Alec and I really like is very low risk yield on Bitcoin. You said you put you put your Bitcoin with an institutional custodian, a QC, I assume, a qualified custodian. Have you given any thought, or are you even now with some of it perhaps generating any yield?
So we've been asked that question a lot. So our philosophy is we're willing with our concierge service to work with each individual investor what they want to do with that Bitcoin sitting there for 10 to 30 years, provided two rules are followed. One is it doesn't jeopardize the tax-free status that they have. So you don't pull it out, of that envelope and it's rehypothecated by somebody or whatever. And two is if it doesn't go well, it doesn't have any impact on any of the other investors in the fund. So part of what we're doing is services and approaching people, who come to us and say, can I do this and this? Those are the two rules that we sort of follow to see. So we are figuring out, and we think over 10 to 30 years, there'll be many, many types of things in yield and other sorts of things that we'll have to filter through that and figure out. We won't do it, but having partnerships that are willing to do that and investors who want to deal with those partners.
Want to turn this into an advertisement, but after this, we should really talk because of of a yield possibility that we have. We once ran an analysis of putting Bitcoin, and now the yields were higher before, but if you had Bitcoin that you did put in yield and Bitcoin that you put in very, very conservative yield over the last 5 years, you would have doubled your Bitcoin with no loss. We don't do it anymore. It's more like 15 years now, but it's still possible. It's still possible to do. Not everyone would want to do it, but I like what you guys do is, hey, you want to just sit on it, do nothing with it? Go for it. You want to earn some yield, and take some risk? You can do this. You want to earn some yield and as low a risk as you can get. There's no such thing as low risk, no risk. Then you can do this. I like that, offering a smorgasbord. It's really clever the way you've done it.
Brian, I have a quick question here about the opportunity zone status. Is the 10-year mark per investor, or is it the lifespan of the fund?
It's per investor's investment. So if you did 3 investments over time, each one would have a separate 10-year clock.
Gotcha. Okay.
Right. Yep. A 10 and a 30-year clock. Let me put it that way. Yep.
Gotcha.
And the other thing is that's very important for your audience is to invest in any opportunity zone fund, real estate, venture, or a Bitcoin fund like ours. You have to invest realized capital gains, right? You can't invest any other sort of structure, which means it's a capital gain that you have earned money and you have to pay tax on. In the big, beautiful bill, they sweetened this thing and they said, if you have a big capital gain, and let's say in February, you want to put in $1 million, into the fund, right? You owe tax on that $1 million gain, but you don't have to pay that tax for 5 years. They give you a 5-year deferral to have to pay it. So the government's giving you 5 years of float if you invest your capital gain into an opportunity zone fund.
That's you could have a massively a massively low basis. If I can use massively low basis in a phrase, extremely low basis asset with a ton of appreciation. Oh, that's lovely.
So they've really sweetened it, that and the estate laws. The other thing is right now, Bitcoin, as we all know, is sort of low. Some people are sitting on some losses. You can use those losses against those gains, right? So if you have a lot of losses or some wash trading, you can, sell those losses, put it in the fund, and immediately buy Bitcoin back in, you can also have a tremendous opportunity. Right now, the Bitcoin price is low. So you, for the same amount, the same $1 million, the same $10 million, you can put a lot more Bitcoin in. And if you have any kind of losses, doesn't even have to be on the Bitcoin, you can use that or use wash trading to then get it in. So there are all these sort of sophisticated, nice tax things, but you have to plan ahead. I get all these calls from these people who are whales. They have enormous amounts in a long time, and they're like, I want to be tax-free now. It's like, well, you have to plan ahead, right? And we can set you up now, but you can't, you've already earned tens of millions of dollars, and you got to bite some bullet. I like to say it's like a Roth. If you know the difference between a Roth and a normal 401k, right? You pay with a 401k or SEP, you put it in tax free, but when you pull it out, you're going to pay taxes. With a Roth, you pay the tax up front, and when you pull it out, it's completely tax free. This is like a super hyper extra large, no age minimums, yeah, and no minimums on how much to put into it. It's like a hyper Roth that you could set up for your 10-year-old, and when they turn 20, it's all tax free for them. It's better than a 529 plan. It's better than a retirement plan. It's like the ultimate tax structure for people who are wise enough to plan ahead and structure it this way.
And you were talking about the wash rule. It's interesting because the 30-day wash rule, I don't want to get too obscure in taxes, but it basically means you can't sell an asset at a loss and buy it back right away. You have to wait 30 days. But that doesn't apply to digital assets. It applies
Exactly.
only to equities. So you can literally, it's down today, sell your Bitcoin, buy it back. Boom. You got all these losses. Use that to offset other gains. It's really good planning.
So let's talk about treasury companies, right? So treasury companies, are putting it on the balance sheet. It's a smart thing to do. They already have some. As they're continuing to buy, you could put it in this structure and think about, if you're a U.S. tax-paying corporation, this is huge for you, right? If you've got, billions on the balance sheet, and a big chunk of that is in Bitcoin and going to stay, you're like, we're always going to hold, or we're going to always hold this part, but we may sell this part. It fits into that structure really nicely for treasury companies.
And in fact, here's some advice for Michael Saylor. He should sell a whole bunch of his Bitcoin, ignoring the effect on the market. Okay, let's ignore that.
More than 36.
Yeah, right. At least 45. Sell a bunch of Bitcoin, buy it back immediately, right? He realizes a loss, offset other gains, take that lower basis Bitcoin, dump it into your Bitcoin OZ fund. He's going to hold on it forever anyway. He's got it for 10 years. He just made it tax free. I mean, my God.
Yeah, their average cost basis is like 76K right now.
So it's a perfect time to move billions of dollars and shuffle it around, and then you're not going to sell anyway. But if you have to, you could get out and just pay long-term capital gains. But so you're not locked in. But I mean, it's the best of all worlds. But you have to be a U.S. tax-paying individual or business to do it. This does not apply to non-U.S. taxpayers because it's a U.S. tax law. And in many states, they follow the opportunity zone law, and there's no state tax on it either. There are exceptions. I think about 6 states that will still tax you on this opportunity zone gain.
And some of them, at least the last time I looked at it, I think California is one of them. They give you half of it.
Yeah.
Right.
So there's some that are in there, but the majority of states say if it's tax free with federal laws, it's tax free for state. Depends. You need to look it up, and you can Google that in your state.
Brian, I want to talk about and ask your opinion about what you're doing with the Opportunity Zone fund, which is obviously for amazing, taking away your capital gains and other tax advantage Bitcoin strategies. Let's call it borrowing against it. Maybe there's some other fund structures, and then obviously hodling and never selling. Talk to me about how you would describe what you're doing versus those other strategies.
So this is really the only strategy that follows the U.S. tax code very, very specifically, and is designed to be such that these funds that you're investing go into an entity that's creating economic impact in low income census tracts in the United States. And if you hold it for that period of time, you are creating work and flows and impact in these communities to advance and move, parts of our US country ahead of the point. Trump said this is one of the greatest economic programs he's ever approved, and it was nice that it was, made permanent in the big beautiful bill. So it's a permanent tax program at this particular point, bipartisan, signed by the president. And it just requires that we're creating jobs and people are having economic impact in these designated areas after a 10-year period, then it goes away. So, and no taxes. So it's different. Let's talk about Bitcoin loans, right? So Bitcoin loans are great. It's also tax free. But there is a loan, and people talk about never ever sell and just borrow, borrow, borrow. But what happens when you die? Nobody talks about what happens when you die, right? There's a loan to be paid off. If you have, $10 million in there and you've borrowed over the time 6 million, 7 million of it, right? The state's only got 3 million. The loan has to be paid off, right? Here, the entire 10 million and all of the gains, are completely tax free, right? So you don't get the money tax free during the 10-year period. Once you get 10 years, 10 to 30, it can be tax free and you get all of it. So that's sort of the discipline that's necessary. And there's no reason this is the only thing you do. You can have your stuff on exchange, you can have it on a cold wallet, you can have it somewhere getting loans on it, you can have some in the Pearl Bitcoin Fund. There's no need to have to say you have to do all one or the other. It depends on your age, depends on how much you have, and all of that you have to mix that and put the right portfolio together.
The one other thing, clarification I'd add is that, Brian, you referred several times to now it made permanent in the big beautiful bill, et cetera, et cetera. The OZ law was passed in 2017.
Correct.
It was temporary when it was first passed.
Correct.
And there are additional incentives to move quickly at the beginning. They've long since expired. And the last aspects of the original bill expired, as Brian said, they expire on December 31st, 2026. And one of the things that we made investments in this family office over time, and it was like, okay, how many years are left? Can we get enough advantage to justify locking it up? And then the other question that everyone was asking themselves at the time, it was in OZ, are they going to extend this or not? And the smart money was probably 80-20, they're going to extend it. And so we figured, yeah, okay, let's pretend it's not all going to die at the end of 2026. And it changed a little bit. It's evolved, and I haven't tracked it super closely recently, but obviously it was extended and improved on top of it. This 5-year delay of capital gains of assets you put into it, that could be massive. I mean, just think, you don't pay taxes for 5 years. You probably double that money with any sort of reasonable return. So you're looking really good. I mean, this is a fabulous law, and it's sort of evolved over time. And now I think we can very confidently say it's not going anywhere with 10 and 30-year time horizons. And to Brian's point, it's not just a tax boondoggle. They actually follow this stuff really closely. You have to either get real estate in the opportunity zones, which by definition increases demand, which drives up the price, or you actually have to have people in the OZ. As you said, not one, but in OZ. That means people living there, people working there, people spending money there. It really does have a substantive effect. So it's the classic example of doing well, very well, by doing good.
Yep. The thing is, for clarity, you have to be creating jobs and people are working. We have to have a lease in an opportunity zone. People are working in that opportunity. They do not have to live in the opportunity zone. And the money for those businesses does not need to come from the opportunity zone. Like you said earlier in this call, it can come from anywhere in the world, your customers. But what they're saying is you're creating jobs. And in our case, with venture capital and with the Bitcoin fund as a Bitcoin asset manager, it is creating good quality, high, white collar sort of good paying jobs. And part of what the Pearl Bitcoin Fund has promised to do is we're in a zone and we have office space. We're going to do regular free education in the opportunity zones about Bitcoin. We're like, we all wealthy family offices and treasury companies, but, a lot of people are living in these opportunity zones like Harlem where we are. know nothing about it, and they need to learn about Bitcoin, especially as time goes on. So we have the space, we have Bitcoin experts. Let's go ahead and do Bitcoin education, in the community.
Brian, I wanted to get your thoughts on where we are in the current market with Bitcoin. We've all seen these cycles. I don't think any of us are panicked, but would love to hear your thoughts on where we are near term, and then more just based on what you're building with the Pearl Bitcoin funds, what that 10 to 20 to 30-year horizon looks like for potential investors and the people who are with you today.
Go, Brian.
Yeah, let me go back to my first Bitcoin investment. Just invest in it and forget about it. So during my years since 2013, I've been buying and selling, trying to time the market, and almost never made money. I usually lost money, right? And it's a great asset when you look over the last 10 years, 15 years, in terms of the chart of all gold versus the S&P versus bonds, it's been a winner. There are some years it's not, but overall it's a winner. And the best thing to do is it's a great asset for long-term holding. Our fund, particularly with the 10-year incentive, is not for somebody, who's thinking about a year or two or trying to get in it. So right now is such a great time on the price. You can get a lot more Bitcoin in your tax-free envelope, but you've got to be the kind of investor that's put it in and forget about it. And then the two biggest problems with Bitcoin is volatility and taxes. If you put it in 10 years, you know, it's going to be volatile, but it's going to be much, much higher in 10 years. Think about in 30 years what the price is going to be, right? And then whenever you start pulling it out at that point, it's going to be tax-free in this structure. So we really have figured out a way, thanks to the US government and our Congress and president, to be able to solve those two problems. If you're trying to time the market, you're trying to make money, you want to get some out, in a year or two or 6 months or 3, that's a different game. There are plenty of other funds and other people can work with you on that. This is like you're a long-term hodler and you believe in it. You're going to put it away for yourself or your kids or your estate or your non-charity or whatever it is that you want to put it in at some point. This is kind of the structure for you.
Perfect. And then you guys aren't actually actively managing the Bitcoin either. It's just sitting in your custodian, and your shares in the funds are representative of a portion of the Bitcoin in that you hold.
For the tax law to work, it has to be a cash transaction. So we can take in kind, but we sell it right away and then buy it right away back in, right? And we buy on the OTC right now. We're using Anchorage Digital. We have a couple other really big players that we're signing up, and then it's custodied by them, right? And you can have single key, or we may have multiple keys and structures and those sorts of things to be able. So basically, we're not rehypothecating it. You can view it on the blockchain. It's just sitting in the most secure place possible. There's so many other games that are trying to beat the Bitcoin hurdle rate. That's for them to do. This is our specialty one. And our jobs and things are taking care of think of it like a Bitcoin private bank. We're protecting your identity. We're making sure it stays tax-free. If you want to do certain services to it, we're working with you and helping you with that. So we created, a lot of customized white glove concierge service for those, who are investing in the fund. And that's our specialty.
Friedrich Hegel was a German philosopher and historian. Marx and Engels took his theories and created communism. The theory was the thesis, in this case capitalism, the antithesis is socialism. They'll merge together, create the synthesis, the ideal world, that's communism. That obviously got discredited, so did Hegel, but it wasn't his theory. Hegel talked about thesis, antithesis, and synthesis. And in today's world with respect to crypto, fiat, TradFi, that's a thesis. Crypto, especially Bitcoin, is antithesis, literally created to replace it. The synthesis is what Psalion also has a VC fund. We're investing in synthesis companies. That is our explicit mandate. One of the things I love about what you're doing is you are a synthesis fund, because you have taken OZ, which is pretty much as TradFi, traditional classic finance as you could possibly get. There's your thesis. You've taken Bitcoin, which antithetical to the dollar, created in 2009, 2008 because of quantitative easing and all the other stuff, created to hopefully replace it in some wild pipe dream that now looks a lot less wild, and you merge them. You are the ultimate synthesis fund from that sort of historical perspective. And these are the things that get me more excited than, say, AI in the TradFi space, more excited than whatever the latest DePIN trend is in the crypto space. What gets me excited are these synergistic syntheses of the advantages of both. And that's what you and your partner, the Poor Tax Fellow, and Pearl Bitcoin Fund are doing.
Thank
I
you. Well, that's
absolutely
nice.
love it.
And I just want to add, Alec, a little bit that um, what we've done is we've signed up some partners to really make sure this is stable and safe. So Morgan Stanley is our treasury company where all the cash is handled. We use a big fund administrator called HC Global to take care of all the KYC and AML and accredited investor and all that sort of stuff. And we're using Anchorage Digital, to OTC and store it. And then we signed up, we went to Deloitte and said, look what we're doing. Look at this synthesis that we're doing. They're like, oh my God, nobody's ever done this. This can't be possible. And so with a lot of work, and we, had to, Paul, my compliance guy, has really tried to do it. And they agreed to be our tax counsel and do our tax returns and whatever. So now we have a big four that's behind us and doing it. So we're trying to build this structure, but the synthesis is a great example. But, when you're new, people are just like, I don't understand synthesis. I don't understand these two things. Our oil and water were never meant to be together. And you're actually right. And that's been really, really fun for us. This is really just a great time to be in this space.
Brian, where can people find more information about the Pearl funds? Where can people find you?
Pearl Fund, just go to our website. It's www.thepearl.fund. So www.thepearl.fund. And you can find everything about us there. If you have questions or interested in investing, there's a form you can fill out there and it goes to us and we'll call you back and do a personal interview and get involved. So you can reach us all through the website. And there's a huge FAQ on there. Every time we do these calls and we get a question we've never been asked, we put it in the FAQ. So go to that and it's very detailed about how every nuance of what we do is done is in there.
Amazing, amazing. The living, breathing document, as Tim always says about our FAQ. Brian, it was an absolute pleasure. Tim, thank you as always for your valuable insight. Brian, we're extremely excited about what you're doing with the Pearl Bitcoin funds. And we're looking forward to the conversation and coming to visit you in Harlem.